Hey everyone, welcome to The Explainer. Today we're jumping right into some really fascinating and honestly pretty provocative source material. It's called Beyond the Vault, the Case for Private Gold Possession. Now, I want you to picture a classic bank vault for a second. We've all got that comforting image in our heads, right? You know, the massive steel and concrete fortress buried deep underground, time locks, armed guards, the whole shebang. For decades, we've been told that this impenetrable vault is absolutely the ultimate safe haven for our most prized tangible assets. But what if that feeling of security is actually just an illusion?
Okay, let's dive into this. The source starts by asking a really simple question, one that kind of challenges our basic assumptions. If you already trust the bank with your cash, why on earth wouldn't you store your physical gold there too? I mean, it seems perfectly logical, right? Well, the material we're looking at today argues pretty forcefully that treating a federally insured bank as the safest place for physical gold is a massive gamble. And unfortunately, it's one you're almost certainly going to lose. According to the text, beneath those shiny marble floors and the reassuring smiles of your local bank manager, there's actually a tangled web of legal, financial, and systemic risks. The author argues that storing gold in a bank totally contradicts the entire purpose of owning gold in the first place. Remember, gold is meant to be a lifeline that sits completely outside the traditional financial system. The source actually breaks down 5 terrifying hidden risks that turn this so-called safe haven into a trap. So let's break them down. Risk number 1, locked out. The reality of bank failures. History brilliantly illustrates this first major point, completely shattering the most common illusion we hold about banking. The idea that you can just stroll into a failing bank and take your gold home? Yeah, that's a complete fantasy. When a bank goes bust, regulators declare a bank holiday. And let me tell you, it is far from a vacation. The source points straight to history for this. Look at Cyprus in 2013 or Argentina's Corralito in 2001. Everyday citizens were literally physically locked out of their own life savings. The doors were frozen shut, and safe deposit boxes were sealed up tight by the government for weeks, sometimes even months.
But the risk runs much deeper than just a temporary delay. The source highlights a seriously terrifying legal reality here. In a systemic bankruptcy, your physical gold doesn't just sit there patiently waiting for you. Oh no, it can get completely entangled in the bank's bankruptcy proceedings. Even if you hold a piece of paper, a receipt for a specific gold bar, legally speaking, you are downgraded to what's called an unsecured creditor. Basically, you're left standing in line with all the bondholders. And trust me, that is the absolute last place anyone wants to be in a financial crisis. Your solid, tangible wealth suddenly becomes nothing more than a digital line item on some court ledger.
Moving on to risk number 2, the threat of confiscation and the ghost of 1933.
We hear it all the time, right? That naive myth that government confiscation just can't happen today. But the source urges us to really look at the mechanics of Executive Order 6102. This was issued by President Franklin D. Roosevelt during the Great Depression. Facing a massive liquidity crisis, the government literally forbade the hoarding of gold. The penalty? A $10,000 fine or 10 years in prison. But here's the absolute crucial detail the source emphasizes. The government didn't send agents door to door searching people's mattresses. They didn't have to. Instead, they just used the banks as a giant, convenient collection plate. By freezing the bank vaults, they squeezed the central choke point. They forced citizens to hand over their gold at $20.67 an ounce. And then, overnight, the government revalued it to $35 an ounce. As the author points out, this effectively robs citizens of 40% of their wealth right then and there.
The core argument made here is that human nature, well, it doesn't change. If there's a severe enough debt crisis, the state will absolutely target massive private wealth that's sitting right there in easily regulated boxes. Storing your gold in a bank, the author warns, is basically pre-delivering your wealth to the exact location the government already knows how to seal.
All right, risk number 3, interconnected system risk, otherwise known as the domino factor. Now, pivoting to modern systemic risks, you might be thinking to yourself, well, okay, I'll just use a small local bank down the street to avoid all this. But the source argues that diversifying into a regional bank will not protect you from the too-big-to-fail monsters. Why is that? Because banks today are just so incredibly woven together. They form this highly combustible grid through derivatives, interbank lending, and shared custodian networks. A short circuit at a massive bullion bank like JP Morgan or HSBC, that sends a massive shockwave that freezes global liquidity entirely. Just think back to the Lehman Brothers collapse in 2008. The global plumbing of finance just completely seized up, and counterparty trust evaporated literally overnight. So the crucial point is really captured in this powerful metaphor from the text. If the banking grid goes down, your gold is basically just a battery attached to a dead grid. It's trapped behind electronic doors that simply will not open. In a hyper-connected crisis like that, physical possession isn't just 9/10 of the law, it becomes the entire law. If you can't touch it, you simply don't control it.
Which brings us to risk number 4, the paper gold trap and legal magic tricks. This introduces us to what the source calls the most insidious and probably the least understood danger of banking your gold. It's a legal magic trick called rehypothecation. It sounds super complex, I know, but the source breaks it down with a great relatable metaphor. Imagine lending your car to a neighbor, right? But then you find out your neighbor lent it to a total stranger who then used your car as security on a payday loan. That is rehypothecation in a nutshell. The bank takes your physical gold, the stuff you allocated, and they create multiple paper claims on that exact same bar to fund their own trading activities.
And the scale of this? It is absolutely staggering. The explainer reveals a shocking estimate from the London bullion market. There are over 100 paper claims for every single ounce of physical gold that's actually available for delivery. Let that sink in. Over 100 claims for one single ounce of metal. Because this entire market is built on this crazy fractional reserve of physical metal, a physical bank run would be catastrophic. If everyone suddenly rushes to demand their bars, the music stops. The system literally cannot honor all those paper claims. And according to the source, guess who the fine print protects? The bank, not you. Your rehypothecated gold just vanishes into a breach of contract lawsuit, leaving you with a stack of frustrating legal paperwork instead of your actual shiny metal.
And this leads directly into the fifth and final risk, price manipulation. The text explains that the price of gold isn't actually discovered in the physical market at all. It's set by massive paper derivatives on exchanges like COMEX. So those very banks holding your gold, they are holding massive short positions to manage and suppress the price. The source actually points to JP Morgan's nearly $1 billion fine for spoofing. Basically, they were placing fake orders to trick the trading algorithms and push prices down. The author's warning here is stark. By giving them your physical gold, you are quite literally providing the liquidity they need to issue more of these synthetic paper promises.
As the text puts it, physical gold in a bank is ammunition for the enemy. Keeping it there is basically voting for the status quo. The argument is that if everyone just took private delivery of their metal, the paper market would absolutely collapse under its own weight, and the true price of physical gold would skyrocket. Section 5. The solution. True financial sovereignty. Let's move on and see how this builds. After detailing all 5 of these severe risks, you have to ask, how do you actually achieve the true insurance that physical gold is meant to provide? Well, the source frames this as a very clear choice between bank storage and private storage. They use a fantastic analogy here. Insurance only works if you can access it when the fire starts, right? If your gold is in the bank, the regulator acts like a fire department that locks your fireproof box and tells you, hey, for your own safety, you aren't allowed near the building. Private storage, on the other hand, gives you 24/7, 365-day direct control. So what are the actionable steps for achieving this financial sovereignty? It's all about taking direct, unequivocal possession. The source outlines a few paths. You could look into highly secure home storage or utilizing private, non-bank vaults. But the crucial thing with those private vaults is making sure they operate under specific agreements that strictly prohibit rehypothecation. The key takeaway is ensuring your storage is legally distinct from fractional reserve banking. That way, your gold remains a tangible asset that you control, rather than just a spreadsheet entry that someone else is leveraging.
The text leaves us with this incredibly powerful metaphor. Banks are an excellent tool for transacting in the old system, but gold is your passport out of it. Owning physical gold is really about deliberately opting out of counterparty risk. It's about stepping up and taking absolute ownership of your wealth. Which brings us to our final thought. If gold truly is your passport to financial sovereignty, you should never, ever leave it with the border guard. So, as we wrap up this explainer today, I want to leave you with this one lingering question to ask yourself. Who is holding your passport?